We were told the financial crisis was the last of subprime that we would see. Unfortunately, that's not the case. We are watching countless Americans finding themselves further and further in debt. It has now become mathematically impossible for millions to ever pay back on their debt. While many investors discount the impact that this could have, those who understand derivatives are aware of how intense the consequences of debt can have on a financial system, which quickly ripples outward. You came here for the truth, so let me unveil that for you. Today we are going to look at what's happening with auto loans. We're going to talk about subprime. We're going to look at derivatives. I want to cover the CLOs. You know that I've touched on this many times before. We're going to look at other economic indicators, stats. I got charts, everything. Let's get into it. Out of Bloomberg, a growing percentage of Santander Consumer USA's subprime auto loans are turning out to be clunkers soon after the cars are driven off of the lot. Some loans made last year are souring at the fastest rate since 2008. We're talking financial crisis levels. Now, of course, this is not as big as what we had back in 2008. I want to make that very clear, and I'm referring specifically to the housing crisis. This isn't as big, but we need to understand that all we need is a trigger. One event to take place that starts a cascade, that starts to snowball into other sectors, into other places where we might not have been looking because things were in fact solid, or at least they appeared so until this moment. Just like back in 2008, we were told that subprime was contained, it's not a problem, it's not an issue, and then of course it took down the entire financial system. Something like this could happen again. Derivatives are the ultimate concern when you look at this on any level. They are massive, they intertwine and interconnect different businesses, different countries, and of course they generally seem to find the worst of the worst, with more consumers than usual defaulting within the first few months of borrowing. That shows you the weakness here, because people are buying things they simply cannot afford. Debt is a very powerful tool. It allows people to buy things they normally couldn't do before. That's why they're extending themselves into mortgages that are way too much for them to ever handle. But as long as on paper it looks like they can pay up, well then they process the paperwork. Many of those loans were packaged into bonds, and I think that this is where a lot of people find themselves without any understanding of the system. We have to take a look at this very quickly. I'll just drop a diagram. You know, when you look at a CLO, a CDO, an MBS, ABS, all of these different things are derivatives, and we take these different type of debt products. Okay, now maybe this is going to be your credit cards. Okay, so you have credit card debt here. Maybe that's student debt. Maybe we're looking at mortgage debt, anything. Okay, let's just take the example here. This is just a fictional example, and we are taking this and we are going to package all of that up into a nice little present. Okay, so we're going to take that, put a nice little bow on top, and we are going to label this, in this example, let's call it a CDO. Okay, collateralized debt obligation, but it could be anything, of course, generalized example. Then we need to get our friends at the rating agencies to give this what they feel is appropriate, and in many cases it is a AAA. Now, just because many people are defaulting in here doesn't really matter. That's not what they're looking for. They want to know that it's diversified. That's right, we are getting these different pieces of debt from all over the United States, and therefore it is so fantastically diversified. But we saw what happened last time in 2008. Didn't end up so well, now did it? So you tell me what's gonna happen. But ultimately, when you take a whole bunch of garbage and you package it up and try to make it look real pretty, then you lie to the people by putting a rating that is very high, whether it's AAA or not. You will inevitably find yourselves in a crisis. Now, whether that crisis unfolds into something much larger, that's a whole different story. This right here, though, has has to stop. And take a look at this here. The rapid failure of some of its loans implies that a growing number of borrowers may be getting loans based on fraudulent application information. Where have we heard that before? Just like last time around, just like we've had examples in Canada only a short time ago, and everywhere around the world, I'm sure, these businesses will do anything to make a buck. They let things slide. It's not as if they make it a policy that they're going to do this or that in order to push up the profits. They let it slide. They turned a blind eye, just like they did all the way through the housing crisis. Everybody knew what was going on, but the profits were so good they couldn't stop. More subprime borrowers are seriously behind on their auto loans, the black line there being less than 620 credit score. Also, the group 620 to 659 has increased somewhat. Delinquent masses, more Americans than ever, are at least 90 days behind on their auto loan. Here you can see that it has actually exceeded 7 million people. Imagine that right now. You're getting this data, by the way, from the New York Fed. 7 million people in the United States are unable to pay for their car. That's not their food. And why? Because 40 million people in the United States are on food stamps. If they didn't have that, we would see absolute chaos on the streets. There is no doubt in my mind. This article out of Bloomberg connects in with this issue, and although it is from the beginning of this year, I still need to touch on it, and I'll move through it really quickly. One of the world's biggest buyers of collateralized loan obligations, CLOs, faces increased scrutiny from Japan's financial regulator, which is concerned about the rapid buildup of CLO holdings on bank balance sheets. Now that's interesting information, obviously, but where do we go from here? How do these groups actually tackle some of the problems that are in the system? The truth is that they never do anything. They never put any meaningful change into the system if they know it's going to weaken the economy. Just a couple points here. While investors in much of the world have cooled on CLOs after a record issuance in the year 2018, market participants say that buying from Japan has remained strong as the country's rock bottom interest rates spur domestic banks to look for higher yielding investment overseas. When you have a company that needs to make profits, if you're not making it in government bonds, if you're not looking elsewhere that are deemed safe, well then you have to take on more risk. This right here is something that they believe is worth the risk. CLOs, will see how this ends up. It is growing at a rate that unfortunately is looking to be very, very troublesome. Japanese regulators join a long list of observers, including the Bank of England Governor Mark Carney and former Fed Chair Janet you-know-who Yellen, who have warned about the potential danger stemming from leveraged loans. We all know what's going to happen the next time around. Just like in any of the crises we have seen, the markets will overreact. Businesses will overreact. This is the way it goes. It always exaggerates to the upside and to the downside. CLOs are held mainly by non-bank investors, although international banks are estimated to hold around a third of the outstanding stock. Just take a look at Japanese banks right here on the side. You could see it does encompass a large percentage of the total. Even pension funds are in here, of course, to a smaller degree, but it is important to note that we can see that these derivative type products have made their way into people's futures. That's not good. CLO pickup yields on top-rated CLOs are near a post-crisis high versus USA grade corporates. And of course, this is the way it goes when you can see these yields falling all over the place. Investors search for more. Now, I thought this was an interesting chart because we have seen what the Federal Reserve has done with the expansion of their balance sheet. We have seen the charts that show the balance sheet and how it correlates to the stock market. I'll show you an example of that in a minute. But this one I thought was worth noting. Balance sheet grows over time based on the growth of the economy. This comes out of Real Investment Advice, and I just wanted to show you something. The red line being the Fed balance sheet, but look at something else here. The blue shaded area is the currency in circulation, okay? And under that is the required reserves of depository institutions. So we can see that these levels are much, much smaller than what the Fed has printed. The orange line is excess reserves of depository institutions. And this is what they were worried about here, because you can see that this had been declining over the past few years at a slow and steady pace, and the Federal Reserve got freaked out. Even though this level was at, I believe, $1.3 trillion or so, it apparently wasn't enough. The market requires excess liquidity, much, much more than we have ever seen before, and there is no way they could ever wind this down. That is a very dangerous predicament that we are in. Now check this out here. Net foreign purchases, treasury bonds, and notes total. Clearly we have an issue going on that over the last few years we have watched this contracting significantly. The peak was 2010, and ever since then it has been going slower and slower and slower. According to Real Investment Advice, the problem is something we have discussed previously, which is a dollar funding shortage. In other words, the Treasury needs to sell bonds to cover deficit spending. If there is a shortage of buyers, then the Treasury can't raise the money it needs to meet spending demands. And what have we seen going on right now? Massive deficits coming out of the US and other places, of course, but the Federal Reserve having to print excessive amounts of money. Hence the need for the Fed to step in to monetize existing debt so domestic issuers can take up new issues. We believe the funding situation is one cause of the overnight funding issues and the sudden introduction of QE. As shown, despite deficits not being as large as in the last recession, the amount of domestic funds required to fund the Treasury deficit is now larger. Take a look at this chart here, something that I absolutely love to see as often as possible, the S&P 500, or I've even shown you the All Country World Index, whether that includes the US or when they exclude it. And on top of that, we see the global liquidity proxy. Ultimately, we're looking at how much money these governments are willing to inject into the markets around the world, and you can see that they always correlate. Now this chart basically just goes from the beginning of the year up until the present, and while there are variances in some cases, you could see ultimately that they move in lockstep. This shows you how important what we can see today, that every move the central bank makes, the algorithms are watching, the companies are watching, and everything rests on their shoulders. There's simply no other way to put it. That's all for this video. If you found it informative, hit that thumbs up button. By clicking one button, you are supporting this channel. Thank you very much. If you want to find out how to build a business, how to actually provide yourself with passive income, then check this course out. It's free. I spent a lot of money to get this up and running, and I provide it to everybody, so definitely check it out. It's at the AmazonGPS.com. The education system kept you from learning about everything that we talked about today, and that's why I wrote these 2 books. I had enough. I simply cannot stand it when people aren't aware of the truth. If you read these 2 books, you're going to get all that foundation. You're going to know about the different asset classes, and then you can manage your money how you feel is best. Or if you have somebody else managing it, you'll be able to ask the right questions. Check this out at the link in the description if you want the audiobook that's available at themoneygps.com. Wait a second, don't go anywhere. This video is so important. Definitely check it out if you haven't already. Click on it and I will see you there.